Hello and welcome to the show. I'm Kim Parley. Great to have you with us. With markets at all-time highs, big U.S. banks have kicked off the second quarter earnings season, and so far we've had some mixed results. Netflix, on the other hand, was up double digits and trading at an all-time high after reporting it added more than 5 million subscribers in the second quarter. So, do the earnings reports so far give any clues to the state of the U.S. economy and overall growth picture? And what does it mean for the markets? Joining me is Damian Fernandes, Portfolio Manager for TD Asset Management, and he joins me in studio. It is great to have you here. And again, we're kind of in the thick of it right now, although I think the big U.S. banks have
just reported.
They've just finished, yeah. So, I mean, what did you see from the big U.S. bank earnings? What was noticeable? What does it tell us about what's coming?
Well, let's split into a few things, Kim. First of all, earnings, as we think about the U.S. banks, they were solid. Look, they beat expectations. There were some gives and takes. For example, revenues for the banks could have been a little better because people thought net interest margins weren't that high. But that's because the yield curve has actually shifted down.
Yeah.
But then on the positive side, loan loss provisions were lower. And so the banks had this fun, and people on the conference calls talked about loan growth accelerating into quarter end. So there's some good things there. The way I think about it, think about the three biggest U.S. banks: JP Morgan, Wells Fargo, Bank of America. If you just average those banks, sales were up 5.5%, earnings were up 17.5%. Single-digit revenue growth, double-digit EPS growth. I think this is a good thing.
That is a good thing.
So even
with interest rates where they are.
Exactly. So I do think the bank's earnings are actually reflective of the U.S. economy, which just seems to be chugging along.
Is it chugging along? Will it continue to chug along, do you think?
I think it will continue to chug along because what you're seeing is a global recovery taking hold. You're having this global coordinated cycle taking place where emerging markets are a lot better, where Europe is participating. And the S&P still derives over 35% of its revenues from overseas. So I think the global growth picture looking better is actually positive for U.S. companies. Let's
take a look at the S&P 500. You've got a chart here which is showing year-over-year EPS growth, and we'll bring it up in just a second. There's a look at the S&P 500 over the last year, as I mentioned earlier, hitting all-time highs. But let's bring in the board, which shows us, again, year-over-year earnings per share growth. Tell me what it is that's interesting about this, because I remember the last time we talked, I think before President Trump was elected, or just after he was elected, you had noted some interesting things.
Yes, it is. It's interesting that we contrasted this with the chart below about the new all-time highs, because people look at new all-time highs and they think that, oh, the market is moving, outside of fundamentals. But take a look at those green bars. That last quarter, Q1, we generated over 17% EPS growth, one of the best earnings numbers in over 5 years. So I think a lot of this market rally has been fundamentally driven. But the most interesting point there is 2 quarters below. So Q3 2016.
That's the last red bar we're seeing.
After the last red bar, that first green bar, what you're seeing is positive earnings growth. Think about Q3. The finish line for Q3 is September 30th. September 30th, I didn't know who the president was going to be. I didn't know what his or her policy agendas were going to be.
But things were turning.
But things were already turning. So the Trump administration basically inherited this recovery that has continued. So I think earnings for this quarter, as you can see in that light green bar, are going to be 9%. I'm pretty comfortable with that number. I'm just more worried going out.
Yeah, let's talk about those gray bars, because these are forecasts, and these are consensus forecasts.
Exactly.
I believe, right? So 17% growth in the third quarter, 19% in the fourth quarter. Your level of confidence in those bars right there?
Pretty low. Yeah. As I would say, as it's pretty low, like similar to it's going to snow in summer.
Really?
Well, it's just that a lot of that earnings growth for those 2 quarters going out are based on much higher growth expectations. They're also based on some policy reform, and they're based on energy contributing a big share of that. And the last time I checked, WTI is still under $50. Yeah. So it's not. I don't want to sound, ring the bearish alarm. I am just saying that earnings expectations as we progress through the year, not this quarter, but further out, are going to be a lot more challenged. You're likely to see negative revisions. But I think the growth picture will be fine, and I think earnings will still generate you high single-digit returns.
Yeah, so 17 and 19% consecutive are... Those are huge. Okay, so let's talk about some of the things I think that are happening in the market, because again, you mentioned before, earnings had turned positive. We saw that 1.7% growth before we knew who the president was going to be. But since the president was elected, in the early days, we saw the Trump bump, so to speak. Everything moved up on the promise of new policy, which was going to kind of get things going. Where are we now?
I think the Trump excitement, the Trump bump, the Trump benefit is completely priced out.
Yeah.
This is one of the few things that
But markets are still at all-time highs.
The markets are all-time highs, but like we said, because of earnings,
right,
which have taken place despite all of any policy improvement.
Which I think is positive.
Really, exactly, it is really positive. So the way I think about this, right, when Trump got elected, the best performing companies in Q4 last year were small U.S. companies. They were up 8.5%. These are companies that benefit disproportionately from policy improvements, as in lower taxes, faster growth. The best performing companies year to date is the NASDAQ, you know, the FANGs, the tech sector, where a lot of their profits come from overseas. They already pay low taxes. Small companies are only up 5.5%. The Russell 2000, which is the index of small U.S. companies, it's up 5.5%. The NASDAQ is up 20%. So you're seeing the market's basically telling you we've completely discounted any policy improvement because the sector the market that benefits the least from it is up the most.
Right.
So I do think on a positive side, if anything happens, and markets like the journey rather than the destination. So if there's any improvements in policy reform, for example, taxes, it's on that path to actually some success, it'll be good.
Well, let's talk a bit about taxes because, of course, what happened is I remember people talking about this and we were chatting in the break that, you know, tackle healthcare reform first, get a success there, get a win and keep on going. You know, that is looking borderline ridiculous now in terms of what's going on. I think tax reform, from what I read, it seems out the window, but tax cuts, is that something, do you think, that could still happen?
I think there's probably a higher likelihood, even despite what just happened in repealing ACA, Obamacare, just because going into next year, the Republican, all three it's midterm elections. So you'll have to have something to show as, you know, we've been successful even by having all three houses. And I think tax is one of the only things that historically Republicans have agreed on. There's a lot more challenges on repealing ACA, Obamacare, but there's unified agreement that lower taxes are better. So this seems to be like, you know, an easy win. So I think like as we progress through this year, that'll be the focus of the agenda.
What do you think though, so you got earnings growth still, it sounds though you think single-digit earnings growth will still happen, still existing. Tax cuts, you know, could happen. They need to happen if the Republicans want to kind of keep on in power, essentially. What does that all mean for the index? Where do you see that going? I
think the index is probably, look, the exciting thing about the index last year was that you had accelerating earnings, you had continued monetary accommodation, and you also had this potential for, you know, policy reform. All of those things are questionable. Like you'll still have positive earnings growth, but not to the same degree. Monetary accommodation, the Fed has raised rates, is talking about tapering, right? So I guess the benefit, and what we've talked about at the start, you potentially have negative earnings revisions. So I'm just not that bullish at the market level. I'm not saying that the market is going to, you know, correct meaningfully. I'm just saying that, as we'd say, probably sideways. But what's exciting is that year to date, volatility has fallen, but correlation has fallen further. I think this is slowly becoming a stock picker's market. So you're having companies that are moving for fundamental reasons because growth is good. Yeah, and not for the all just as the market as a whole, exactly. All right, stay with us when we come back. We're going to see where Damian has been sharpening his pencil and what stocks look interesting to him. You're watching Money Talk. We'll be right back. As promised, I'm here with Damian Fernandes. He's portfolio manager with TD Asset Management. We've been talking about market conditions, the earnings, which have been looking pretty good, and again, just kind of questioning the environment we're going into. Damian was also just saying this is a good time for active managers. I mean, this comes down to actually picking the right stocks because you're seeing a lessening of correlation, which I can hear active managers saying hallelujah on that. But anyway, companies are moving on fundamentals again. Yeah, it's been a while. So you've got here some names, and I'd say some themes based on some of the things we were talking about earlier, and you brought a chart in. Let's bring it up, and this is a look at some of these U.S. financial names. Tell me why this is interesting. Well, this is, so what you have in front of you, Kim, is a table listing the largest U.S. banks, and if you can focus on that column that says shareholder yield, let me spend a second explaining that. So the banks every year have to ask the Federal Reserve how much they can pay back to shareholders in dividends and in share repurchases. So that's the amount. That capital return, that second column, is basically how much they can pay back, and they will pay it back. So owning these U.S. banks, you're basically getting 7.5% shareholder yields for the next year in the bank. Like, this is in the bank for the banks.
Right.
Right. And I think that's extremely attractive, especially when you look at that last column, which is the next 12 months PE.
Now, the one thing that we were just chatting about, because you're looking at all these in anywhere from 11.2 to 12 times PE, but the market is trading right now at 17.5 times forward PE.
And the market dividend yield is 2%.
So what's going on? Why is that the case?
Because for these banks, no one believes in the sustainability of these earnings.
And why don't they?
Just because I think it's still a residue from the financial crisis. It's because of the regulation for the last few years. But the banks have become much better businesses in terms of expense control. And they are, people forget this, they are levered plays on the economy.
Yeah.
If Trump is even halfway successful passing taxes or accelerating growth, these bank earnings, revenues accelerate.
Yeah.
Right? They still pay U.S. taxes at a high rate, over 30%. If you're successful at tax reform, this is the basket you should be in. So we think of the banks more as just, look, you own them because the yields over the next year are going to be really solid. You're buying them at generally below market multiples, but there's this optionality where if anything, any policy reforms are successful, they benefit from.
And you've also got, I guess, the tailwind of interest rate increases when it comes in as well.
We haven't even talked about that.
Yeah.
Yes.
What is the, I guess, and just to play devil's advocate on them, I mean, what's the negative optionality in your, you've got, could see tax reform positive, could see this. Is there anything that kind of would go against them right now? Is it just a slowdown of the economy in general?
Two words, lower rates.
Yeah.
Because just lower rates will disproportionately affect their net interest margin to the downside, where they just won't make as much money from that spread. And I think that will, and that's what the market is, that's why you're seeing those multiples, because they don't believe in a period of sustained higher rates than we are today. You just need the curve to be steeper.
Right.
So that is literally the risk.
Yeah. Okay. What about some other names apart from financials and some other plays you think are interesting? Nike is one of them.
Yeah, we love talking about what we'll call secular quality compounders. What do I mean by that? What I mean is that companies that will grow earnings, but the market has underestimated the profitability and free cash flow, not next year, but for multiple years out. Where these companies, because of the industries they're in, and for example, Nike's a good example because it's a pure play in athletic goods.
Yeah.
In an oligopoly.
Yeah.
There's 3 companies with Sports Authority globally: Nike, Adidas, Under Armour. So I can tell you 3 years from now, there's going to be more sports goods sold, more athletic equipment sold, and Nike participates in that. It's just a matter of people are focused on the near term, whereas Adidas recently has had a better lineup of goods.
Yeah.
But Nike still participates in this.
And it ebbs and flows, right?
Exactly, in this health and wellness trend, like people taking responsibility for their bodies, and like this is the sweet spot.
Yeah. I'm waiting for when Nike gear becomes okay to wear to the office all the time, and then that'll be a big one. Be good for me anyway. So. Oracle, last one you've got here too. Why is that one interesting?
Oracle's interesting because there's increasing evidence that it's successfully migrated its business model.
Yeah.
If I can spend a second on this, so Oracle is a software provider, the largest database software provider.
Yeah.
We love software, because as soon as you create the software, the cost of creating a new package to sell to someone new is free.
Yeah.
So the margins are infinite. So software as a business is beautiful. Oracle, historically, what it did was that it sold its software up front, and then it would collect a small fee. They are migrating to something what Microsoft did a few years ago, where we're moving to software as a service, where instead of paying a big upfront cost, you pay an annual fee. Yeah. People believe that because there's confusion, because you have a drop in the revenue, that sometimes that it might be a question about their, the viability of their products. But now you're seeing increasing evidence. Oracle's had 2 blowout quarters. People are like, oh, you know what? They promised double-digit EPS growth for 2018. That's very likely. And it's one of these high-quality compounders, more cash than debt, solid free cash flow generation, software high margins. So we like these companies. And
what about just size? Because, you get to a size as well where it gets hard to grow at the same rates that you were before. How much is that an issue with Oracle?
Well, we talked about both these companies. Nike is, I think people are underestimating, my point about quality compounders, are underestimating the total addressable market. Yeah. Nike's revenue is $36 billion. That's still really, really small when you think about global branded athletic goods. Yeah. Right? Oracle's movement to getting people, there's more data is a phenomenon we're going to be living with. with, you'll need more database providers. And large companies will move to successful businesses that they already deal with, Oracle being one of them. So I just think the people are actually underestimating what is the growth. I don't think about size in the absolute sense. I think about winner-take-all markets. And these are examples of companies where they will participate in a disproportionate share.
Damian, always a pleasure. Thanks so much.
Thank you, Kim.
Damian Fernandes, he's a portfolio manager with TD Asset Management.